It's hard to believe we're going in May already. So, okay, well, I know you guys were started here on time, so I just want to introduce myself and hope you guys, if you have not known me, my name is Dolph Janis from Clear Income Strategies. I've been working this industry since 2004, and during these virtual times that we're going through, we're doing everything, a lot of things, virtual appointments right now, phone appointments. We have go-to meetings. We're doing one-on-ones quite often on this way. You'll see on the handouts on the far right of your computer screen, you'll see a couple boxes. One will be a chat button, another one will be a questions button, and then the other one will be a handouts button. We have two handouts there. One of the resources that we offer here through Clear Income Strategies Group, and the other is a tax guide, the 2020 tax guide. It's a lot of information. It's great, and you guys can just print that right out. And any of the other resources, just let us know, and we'll do that. So I'm going to take my mug off the screen right now for you, and then get ready to start talking. And I hope you guys enjoy the presentation. Usually this is a lot of detail, and this one a little bit more than most of my webinars, but this is a big topic going forward. Obviously, if you haven't listened to my show, it's on every Saturday in WBT at 4 o'clock. And then to see what other topics we got, Lauren's already got them up and running on donotlosemoney.com. The next 3 weeks are pretty exciting. We're looking forward to those webinars as well, so you can go see the signups for those for yourself. And if you haven't had the pleasure of seeing me, I've been featured in all these publications out there. This is real news, not fake news. So if you want any of those publications, you can get access to those on our website as well. And if you haven't received a copy of that book I had published last year, Cross the Bridge Retirement, all you have to do is call or text that phone number 704-307-0202, or email. We'll be more than happy to send you either a hard copy or a e-copy, whatever is most convenient for yourself. Now, jumping right into it, Social Security is a very interesting topic. So choosing when to start Social Security payments may be one of the most important decisions you make in a retirement income process. It can have a significant impact on how much guaranteed income you and your spouse receive for life. I mean, Social Security has been around for a long time, and it's meant to be there, and there's a lot of intangibles and changes out there, and that's what we're going to try to cover a lot of that today for you. So start off with some examples. For example, if you were 62 years old with a maximum career earnings and started benefit at full retirement age of 66 years and 66 months, that's based on a 1957 year of birth, you could receive about approximately $686,000 over the next 20 years. And that's not even including annual cost of living adjustments or spousal benefits if you're married. This hypothetical example is based on a 62-year-old with work earnings that reached and exceeded the annual income used to calculate Social Security benefits. It assumes that the benefits begin at full retirement age of 66 and 6. The maximum benefit retirees is about approximately $2,861 in 2019. From age 66 and 6 months to 86 and 6 months, that retiree would receive approximately $686,000 some change, including cost of living adjustments, which they know as COLAs, or any other available spousal benefits. That's a lot of money. When you think about the whole kit and caboodle, that is a lot of money to think about working with. And that's not even including the annual cost of living adjustments benefits. I mean, if you're married, I mean, if you look recently, there haven't been that many cost of living adjustments out there, but they're out there. So we're going to get right to the agenda. The agenda today is understanding your choices and how to decide when to start, strategizes to maximize your retirement income, and factoring in Medicare, which is very important. This presentation is going to provide you with information, ideas, and some tips on how to maximize your Social Security benefits. But first, we're going to discuss the Social Security retirement benefit options that are available to you. Then we're going to go over the steps that you should take to decide the best time to take Social Security and different ways of filing for them. Remember, everybody's situation is different when it comes to Social Security. There's not a one-size-fits-all. It's more of what works for your situation the best. Now, understand your choices. There are quite a bit of. There's a nice little chart, and it says if there's any slides that you didn't get a screenshot of or you want us to recover, just go ahead and ask us. We'll be more than happy to do that. But On the right is basically the year that you were born and when your full retirement age is. So your options are basically you can take early payments from ages 62 to 66, depending on your year of birth. You can start benefits at full retirement age between 65 and 67, depending on your year of birth. You can delay and even get more from full retirement age to age 70. You can capitalize on spousal benefits. So if you're married, you may be eligible to receive a spousal benefit, even if you're not entitled to any Social Security benefits based on your own record earnings. That's very important. A lot of people don't know about that one. And of course, the enhanced survivor income, it's important to consider survivor benefits and managing your Social Security benefits. By delaying payments to age 70, you may be able to increase the amount of your spouse receives once you pass away. With most of these options, the later you claim, the more you can receive from Social Security, but we're going to talk about later about the break-even point going forward as well with that. So a lot of people are like, well, it's my money, I want to take it early. I mean, Social Security benefits can begin as early as age 62, but in some cases, benefits were reduced up to 30%. Generally, 25% is the norm. So, for example, if you begin retirement at benefits at 62 from your full retirement age, your 1,000 benefit would be reduced by 25% to about $750. If your full retirement age is 67, then that's where the 30% kicks in, and it will roughly drop it to $700, as you can see on the chart. So, depending on when you turn that age, based on your date of birth and year of birth, you'll see it here on the chart. It's going to show you what your benefits are going to look like. Very important information to know, because this is your money, and generally, a lot of people, we talk about Social Security, it's one of your biggest assets in retirement that people don't realize. If, like we just talked about, 686,000, and you times that by 2 with married, is your 401k worth 1.4 million? Is your savings worth 1.4 million? Is your house and stuff and assets worth that much generally? So maximizing Social Security the right way is excellent, but also at the end of the day, you got to do what's best for yourself. See, option 2 is you start at full retirement age. The second option, starting at full retirement age by claiming age benefits or later, you'll be able to receive 100% or more of your Social Security benefits. Plus, you'll have the opportunity, excuse me, to add more earnings to your work record. Social Security benefits are based on the average of your highest 35 years of earnings up to the maximum amount. If you haven't worked at least 35 years, or if you had low income in many of those years, working longer may add actually higher earnings to your work record, resulting in greater Social Security benefits in retirement. So just because you didn't do it earlier means you can do it later, and you can add more money to that. The third option is delay and get even more. You delay start Social Security benefits until after full retirement age, you'll have the opportunity to earn even more, and you see on the chart the increases that it can go up to. Delaying payments until your full retirement age will allow for more delayed retirement credits to accrue, increasing your benefits up to about 8% a year approximately. The yearly rate of increase depends on your year of birth, as you can see from this table. If you were born in 1943, your annual benefit can increase 8% every year from full retirement age to age of 70. There is no additional benefit increase after you reach 70, even if you continue delaying to take benefits. The rate increase is calculated by a simple benefit of your full retirement age. Very important to know what your benefits are and when you're going to take these benefits going forward. Capitalizing on spousal benefits. I mean, if you're married, you will generally receive the greater of your own benefit based on your individual earnings, up to about 50% of your spousal benefits. Spousal benefits is reduced by 35% if you claim before your full retirement age. It's very important to understand. And similar, if you claim prior to your full retirement age, the sooner you claim, the more your reductions. Note, by claiming the type of benefit prior to your full retirement age is deemed to be claiming all types of benefits in which the recipient is entitled to. In addition, if you're divorced, you can still receive benefits based on your ex-spouse's record if your marriage lasted at least 10 years and you've been divorced for at least 2 years. Both parties are at least 62 years of age and you're currently unmarried. If you remarry, you generally cannot collect benefits based on your ex-spouse's benefits, unless the second marriage ends by death, divorce, or annulment. So we don't really talk about death and not saying, well, don't get married, but there are actually a few people out there that I know that have been divorced, and they're with another couple, but they're not getting married. They're just collecting the benefits and so forth. So they're using the system to their benefit. Again, another benefits out there of a lot of times out there I've seen people not realize they're getting a spousal benefit and a divorce benefit, and then they have to go back later and then file for them. And generally they'll get them pretty quickly, but it's a lot of work to get that done. Option 5 is an enhanced survivor income. We'll discuss this here. Widowers have the option to keep their own benefit or switch to a deceased spousal benefit if it is higher. Survivor benefits are available as early as age 60, but they will be reduced by 28.5% if claimed before a full retirement age. A widow or widower who is disabled can get the benefits as early as age 50, actually. A divorced widower or widower may also be eligible for benefits. This is something very interesting to look into and ask your tax accountant if you qualify, but also if you're above 56 years old, it doesn't matter. And for retirees who anticipate a shorter retirement due to health reasons, survivor benefits should be considered during their retirement income planning process in order to help ensure that their spouse has optimal benefits through the rest of their lives. This is just another way of making sure the benefits are passed on and created properly. Next up on our agenda, we're going to discuss Social Security options available to you. So we're going to start on how to decide when to start Social Security. 5 keys of deciding when to start. Like I said earlier, everybody's situation is different. You got to estimate your Social Security benefits. You got to consider how long your retirement will last. Determine if you're going to continue working, because now there goes into number 4, look at the tax consequences, because they can tax up to 85% of your Social Security, depending on how much income you have. And also you got to consider the impact of potential spousal survivor. Reading problems today. Consider the impact to potential survivor benefits as well. So those all are big key factors on when to start dipping into Social Security. First, you should take a few minutes to estimate your Social Security benefits and see how they relate to your retirement income needs and goals. Start by determining how much income you're going to need to retire. Most financial experts, and so myself, including myself, estimate that you'll need at least 70 to 80% of your current annual income to maintain your current lifestyle in retirement. To get an idea how much generated income Social Security can provide, there's an online calculator at Social Security website, which is ssa.gov/estimator. You can input your personal information and Social Security card number, and you'll get the most recent updates on how to receive age 62, full retirement age, and age 70. These numbers can help determine if it makes sense to delay or start your Social Security right away. I'm going to leave the screen up here a little bit because every time I've done this presentation, people have shot questions. There's already a couple of questions I've just got popped right now just saying, Dolph, can you send me that before I don't leave it? So I'll leave the screen up here for a few seconds so you can write that information down or take a screenshot of it. And if you have a screenshot on a Mac, I think it's Control-Command-3 to do that for it as well. And for those questions coming through, thank you very much. I will get those for you when we're finished. Okay. This is a question that really nobody knows, but people try to guess because it's one thing out there in life. It's like you don't know how long you're going to live, hence how long your retirement will last. So the second step is to consider how long your retirement will last. Longevity plays a key role in determining which option is best for you. In fact, if you expect a shorter retirement due to health or other reasons, you might want to consider claiming earlier with reduced benefits. But so, example, if you look at the hypothetical illustration that's on the screen, assuming a monthly benefit of $1,000 at full retirement age at 66 and 6, it illustrates the total income you would need to receive to claim Social Security at 62, 66, and 70. Even though taking early payments at 62 means a reduced monthly benefit of $725, in this example, the strategy would still provide you more income to the age of 78 years old. It's a 16-year break-even point. That's very important, and we'll talk about that in a little bit, but that's a huge break-even point. And as I was talking to some clients earlier this week, actually yesterday, when do you want your money to be most beneficial to you from ages 60 to 80 or from 80 and going forward? And if you live past 82, you've been better off waiting to take Social Security, but that's something you have to look at with your lifestyle and benefits going that way. Another one is people are working more into retirement, whether it's a part-time job That Home Depot at the office, I mean, finding part-time jobs right now is very tough, but I'm sure they're going to be coming back. You should determine if you're going to continue working. If you work and take benefits prior to full retirement age, some of the benefits may be withheld. These reductions are on top of any reductions for starting payments before retirement age. This is how it works, and this is some people, when I said, I think a lot of people take a picture of this screen as well or ask me to send it to them, but benefits are reduced by $1 for every $2 earned over 17,640 in 2019 before full retirement age is reached. In the year full retirement age is reached, benefits are reduced by $1 for every $3 earned over 46,920 until full retirement age is reached. Benefits are not reduced once you obtain full retirement age. That's very important. Benefits are not reduced once you hit full retirement age. However, it's important to realize that any amounts withheld are only temporary. Reductions made as a result of wages are added back to your benefit after you do reach full retirement age. So, in ending, there's no penalty for working longer. Benefits aren't lost, they are simply just deferred to you. A lot of people didn't realize that. So the money, but you got to ask for those benefits. Most of the time, they're not going to just send them to you. You got to go back and get them. Looking at tax consequences, the fourth step is looking at for Social Security benefits. Depending on how much you earn in wages and other income, like I mentioned earlier, you could pay up to 85% on Social Security benefits. Ouch. Last time I checked, you already paid taxes on Social Security, and I got to pay up to 85%. Boom. Here's a little chart with this is updated with last year's numbers, and like I said, on one of our attachments, these numbers are updated as well. To determine the taxable amount of your Social Security benefits, just need to add your adjusted gross income, your tax exempt income, and 50% of your annual spousal Social Security benefits. If this amount exceeds 34,000 for single or 44,000 for married, I think that's up to 36 and 46. Right now, I apologize if I miscorrected that on the screen. 85% of your benefits are subject to ordinary tax income. Again, I'm not a tax advisor. We have Wally and some other people in the building that are tax advisors. They work with a lot of our clients. That would be someone I would recommend you contact to verify what that number is. And then again, don't overlook survivor benefits. When you begin Social Security payments can increase the survivor benefit for your spouse. For example, if you earn more than your spouse and you want to leave him or her with a larger benefit, you may want to consider waiting until after your full retirement age to start Social Security. This way you can help ensure your spouse receives the higher benefits after your death. In terms of retirement income, a surviving spouse has a choice of either taking his or her benefit that is of the deceased spouse, whatever is higher. Of course, you're going to take the higher amount for the record. If the survivor benefit is higher, you may want to avoid taking it prior to full retirement age, as you reduce benefit up to 28.5%. Very important to understand that number. There are other ways you can use survivor benefits to help maximize income. We'll take a look at that more detailed example in the next section of this presentation. So now we've covered understanding your choices and to decide when to start. Let's talk about strategies to help maximize your retirement income along with Social Security. Important notices concerning changes to Social Security in 2015 was the Bipartisan Budget Act of 2015, resulting in a number of major changes to Social Security, including the availability of certain filing strategies like file and suspend and so forth. I'm not going to read this whole slide, but this is very important to understand that they've made a lot of changes in Social Security over since 2015, and it's not going to end. That more changes are going to come, especially with the stimulus package that just got knocked through. We're in an election year, so keeping up to date. We if you follow us on social media, anytime there is a change on anything we do, post it on social media. Lauren is fantastic on getting that information out to you. One of the changes was spousal benefits was a restricted application. So if you were born before 1954 or later, or in 1954 or later, you will no longer be able to claim the spousal benefit for a restricted application. This is the old file and suspend. As a result, you'll no longer be able to claim a spousal benefit and switch to your benefit later. But if you were born before 1954, you continue to have the option to restricted application for a spousal benefit, only provided you do not file for benefits before your full retirement age, and your spouse has not either filed for receiving benefits and suspended prior to Well, that's tomorrow, April 29, 2016. Again, this is very important. The file and suspend is to know it's only available if you were born before January 1st, 1954. And if you were born before January 1st, 1954, and you're not using this strategy, give us a call or talk to your accountant and get ready to get on board with that strategy, because there's a lot more money to be made with that. Now let's take a closer look at spousal benefit strategies we discussed earlier. One variation of the strategy is to combine early and delayed payments for married couples in order to generate more income. Keep in mind, if you were not age 62 or older as of December 31st of 15, unfortunately, this strategy is no longer available to you. But if you were, the strategy, the lower income spouse earning starts taking income right away from Social Security at 62 and receive reduced benefits. The higher earner would start taking benefits at 66, delaying his benefits for maximum income. At age 70, the higher earner takes his own benefits and the lower earner switches to spousal benefits once again to generate higher income. Once again, the dates prior to 1954 and April 29, 2016 do come into play. Now, this is just using the file and spend, start now and get more later. It's ways of generating $215,000 plus more. This is assuming Fred and Jane are married. They're 62 years old with full retirement age at 66, and their Social Security benefits at full retirement is $2,400 for Fred and $1,000 for Jane. You can just see here, monthly income at 62 is $750, then becomes $1,250. Fred elects his spousal benefits and half of Jane's benefits, so it goes up $500 because Jane continues to receive her $750. Then at age 70, Fred takes his full delayed benefit, which is now jumped all the way to $3,168. Jane elects spousal benefits to generate more income because she gets a deferral of $950. So boom, they get a little over 1.1 million and some change at age 90, and that's over 215,000 they've received by doing this one simple step. Obviously, if you were born 1954 or later, the strategy is not available to you, so I apologize. It's not my rule, it's their rules. So I just need to take a little sip of my coffee. Second, if you're a higher earning widower or widow, you may want to take survivor benefits as early as age 60, even if you reduce benefits. That's because you'll be that is because you'll be able to earn extra income from 60 to 69. You can delay your own benefits, allowing additional credits to accrue, helping you generate more benefits at age 70 when you claim your own benefits. This is one of those, you take it earlier on a survivor benefit, you continue working, those credits delay, and you get that money later in life. Nice little paycheck coming to you at the age of 70 is always a nice thing. So once again, this is to clarify that one, the way to receive an extra $85,000 and change. Bob and Cindy are married, born in 1959. They're 60 years old with full retirement age of 66 and 10 months. Their Social Security benefits, $2,400 for Bob and $1,000 for Cindy. And Cindy passes away at the age of 60. So Bob claims survivor benefits and receives 71.5% of Cindy's benefits, $715. Total benefits paid from 60 to 69, it's $85,000 and change. That would have been lost if Bob did not take advantage of these benefits. Then boom, Bob takes his benefit at age 70, which is $3,000 and some change a year. So he's not, if Bob would have taken benefits earlier, he would only receive a portion of the benefits. What we're trying to do here right now is just show you different ways of not leaving any money on the table. The government's so apt to say, hey, give me your money, give me your money. We're trying to show you ways of, hey, this is your money, let's keep it and get more money for yourself. Then we can build an income bridge to help increase future benefits. So if you decide to retire later, you may need to build that bridge, potential income gap with sources other than Social Security. Possible solutions, obviously people use fixed annuities to use for income. They use indexed annuities with optional income benefit riders that will provide guaranteed lifetime payouts. There's retirement plans and accounts like 401ks and IRAs that can provide you with income after you reach 59. Obviously, before that, they'll charge you a penalty of 10%. And withdrawals and earnings will keep you subject to ordinary income tax. These are not guaranteed lifetime payouts, but they're ways to supplement your income. Like sometimes ways of using it is like using a Roth IRA between 62 and 66. First of all, you're not paying taxes on the Roth IRA, and then you're increasing your income benefits for Social Security. Then of course, also you have mutual funds, and then last, earnings from work. So earnings from work to generate income before you reach 70. You might want to continue working if you do. I know some people on this call, and a lot of my clients are working part-time jobs to get some extra benefits and tack on their money later in life. So one of the big people, I always like to do this little presentation, is once again, what is the break-even point? Where is Social Security the best of taking it? Because you don't want to leave money on the table. Again, you don't know what your health is going to be, so meet these triplets. These are obviously fictitious people. They're not actual clients, but we got Earl, we got Stan, and we got Dell. I didn't name them, but that's a long story. I'll leave it at that. Okay. Now we're just going to basically on a basic $1,000 of benefits at full retirement age of 66. You can see the 25% decrease going forward for them, and you can see at 62 they'll get $750. If they defer all the way up to 70, they'll get $1,320, depending on when they take their benefits. So let's just see who's going to win in the race to getting the most amount of money. And once again, I know it's Las Vegas is closed and also all the casino, but this is another one of those Social Security gambles. I know we always talk about the stock market being the casino, the roller coaster, which you're going to take. You don't know when you're going to win. Well, here's your Social Security gamble. First, we're going to talk about Earl. Earl believes taking out Social Security benefits early will be more lucrative. He plans to bank each check and just let it accumulate. He thinks his money will outgrow his two brothers. That's what Earl wants to decide. That's his situation. Earl's going to go with it. Good luck to you, Earl. We're going to cheer for you. So Earl's Social Security payments obviously reduced by 25%. So it's based on the $1,000. Earl's going to receive a little bit, give him a little nickname. He's got $750 a month. That's $9,000 a year. So over 4 years, he's going to have $36,000 in Social Security benefits. Not bad. Now we're going to go to Stan, and we're going to give him a little nickname since he's the middle guy, Standard Stan. He's going to wait until 66 to start taking Social Security. So now he's going to start receiving $1,000 instead of Earl's $750, and he's looking to outpace the amount Earl would receive. Can he do it? Is the question. Tension builds. So, assuming $1,000. Dell better live a long time because he waited till 70 at $1,320 a month. He would have to live past the age of 84 to start receiving more income. So he has a 14-year break-even point. Once again, 14 years, it's a long time to break even. How about between Earl and Stan? Well, guess what? It is a virtual tie. I mean, we're talking nickels and pennies right there, come down to the virtual tie area, because Earl would collect more if they both died before 81.4. Stan would collect more if they lived beyond 82.4. And there's a little chart below that shows the probabilities and stuff like that, and boom. So at the end of the day, people can take their money at 62 versus 66 and still outperform how much money you're going to live. Because again, nobody knows how you're going to pass away. I'm not a tax accountant. I'm not telling you which way or the other, but if you can supplement your money and still work from 62 to 66 or 62 to 80, don't forget about those extra credits that are going to be popping up that you'll receive at a later date. So the important factors to consider in this whole thing, though, is what if interest rates rise? The length of life makes a huge difference, and human nature is hard to ignore. Those are the important factors that no one can answer. Those are the unknowns as we talk about in retirement planning. The last part of this agenda is factoring in Medicare. Okay, as part of retirement income planning process, it's important to factor in healthcare related costs, including Medicare. It's a federally health insurance program for people who are 65 or older. Medicare may be available to younger people with certain disabilities and people with end-stage retinal disease, which is a permanent kidney failure required for a transplant. I'm not a Medicare licensed individual. I'm going to go basically on the notes that I've been provided with and understanding Medicare. We have Jeff Conyers, if you've not met him. He is our Medicare agent here in office. He's been doing this for well over 20 years. He knows all the different factors when it comes into Medicare. So he would be the one to answer. If you have any questions on Medicare, boom, ask him. We'd be more than happy to pay down there. But here's the nuts and bolts on the impact of Social Security benefits. You may not know it, but Medicare costs directly impact your Social Security benefits. If you receive Social Security retirement benefits, your Medicare Part B premiums will automatically be deducted from your Social Security check. There's no other payment option. What's more, Part B premiums are higher for those who with higher reported income as Part D premiums. As a result, your monthly Medicare Part B premiums can put an unexpected dent into your Social Security check. If you don't need coverage provided by Part B, you may want to opt out. It's also worth noting that if you elect Part D prescription drug coverage and choose to have your premiums deducted from your Social Security benefits, this again will reduce your Social Security check. Again, that's why I always mention whether you have Social Security now or you're going on Social Security, it doesn't cost anything to talk to Jeff for 15 minutes. I'm like the Geico commercial. 15 minutes with Jeff can save you 15% or more on your Medicare insurance. Medicare Advantage Plan, and you refer to the Social Security brochure handout that we can provide for you, but you should also know that your Medicare coverage can be accessed through Medicare Advantage plans, sometimes called Part C. These plans are offered by Medicare-approved private companies. Your Medicare Advantage plan combines and replaces Part A and Part B coverage and may provide additional coverage. Your Part B premiums will still be deducted from Social Security benefits, assuming you reach those benefits, and you may pay an additional premium for Medicare Advantage plan. Extra coverage may include vision, hearing, and dental, and most of the plans include prescription drug coverage. Again, most of the plans include prescription drug coverage. If you choose to go with an original Medicare, that is, you don't choose Medicare Advantage plan, you'll have the option to purchase a Medicare Gap policy to help pay for some of the healthcare costs that Medicare doesn't cover, such as co-payments, co-insurance, and deductibles. A Medigap policy is an additional expense you may want to keep in mind as you consider your retirement income needs. It's also important to note that Medigap policies generally don't cover long-term care, such as nursing home, or vision, or dental care, hearing aids, eyeglasses, or private duty nursing. As a result, these are additional expenses you need to prepare for as you develop into your retirement income plan. Medigap policies, which are offered by private companies, may also cover benefits from Medicare doesn't, such as coverage for emergency health care services while traveling outside the U.S., all policies and some basic benefits, but additional benefits as well. The costs associated with Medigap policies may vary. Very important information to understand about Medicare and all the different things for Medicare going for you. So at the end of the day, I mean, when it comes to choosing the best Social Security option for you, you now need to keep in mind that Social Security is more restricted than ever on allowing filing changes. So ask yourself, when do I want to retire? How do I want to spend my retirement? And do I have the right strategy to achieve my goals? I'm always available to answer these questions. Of course, Jeff answers for any Medicare advantages, for any income strategy remains consistent with your long-term financial goals. So please don't hesitate to contact me or a member of my team for any of the questions that we've listened to on Social Security or its benefits as well on that. Again, I want to personally thank you everyone for taking the time to attend the webinar today. I hope you picked up a few notes. We have full slides that are available to you that we can present to you as well. And again, the other webinars that are on there are at donotlosemoney.com. And of course, if you want to have a free Social Security analyzation report, we can be more than happy to do that for you as well. You just have to call and set text. We can actually do that virtually for you guys as well, right over the airways. So each one of you, thanks again for taking the time out of your morning to listen to the Social Security Savvy information. Be safe, be blessed, take care of yourself, and I hope to talk to each one of you soon. Okay, have a wonderful day, and thanks for coming in again. Bye-bye.